Hello and welcome to 5-Year Club video number 161. Today will be a fairly brief topic, but one that I think is important for people to know. The fact of the matter is, in the United States, most people build most of their net worth in real estate. So if you have some net worth, on average, most people have it in property. I don't recommend that, but it's a statistical fact. So if an equal cross-section of people across the US are watching this video, if you ever inherit anything, most of those people would inherit it in the form of some kind of house, some kind of property, which is why it's really important to understand how property inheritance works, and very particularly how tax works around these properties. If you inherit a property, then the tax basis will be stepped up to the fair market value. What does that mean? Well, if you buy a property at some kind of price, like say $150,000, let's say, and the housing market changes, it rises, and later you sell that property for say $450,000. That's a very good deal. You've made $300,000 on that property. Normally, if you had bought something at $150,000 and sold it at $400,000, you would need to, or $450,000, you would need to pay some taxes on that gain. That's how a lot of businesses work. They buy wholesale goods and they sell retail goods, and they have to pay taxes on their profits. In the case of real estate, though, the U.S. has a special rule that says you will be exempted from $250,000 of gain per person. So if you're a married couple and you own everything jointly, then that's $500,000. It's a good deal. Now, in the example that I gave, what that means is that the property was purchased at $150,000, it's sold at $450,000. There's $300,000 of gain minus $250,000 of exemption, so you have $50,000 of gain. You have to pay some long-term capital gains tax on that if you held the property for over a year. So that maybe could be 15 or 20%. So you're paying $15,000 or $20,000 in, 20% would be $10,000 of the $50,000 difference there, or I guess $7,500 would be 15%. So you're going to be paying something like $7,500 or $10,000 in taxes. This is why stepped-up basis is so cool. Because in a stepped-up basis situation, say this was a parent's home, and they bought the home at $150,000, and it's now worth $450,000. Now, normally, if it was some other, if this wasn't an inheritance situation, you would have to worry about that $300,000 of price difference and its tax implications. But in the case of inheritance, the basis of the property is stepped up. So instead of the basis being the purchase price of the property, the basis will be the fair market value of the property at the time of your relative's death. So it would be stepped up to $450,000, which means that you will not be paying any tax on that property if you sell it. So I want to read through just a quote I grabbed from a website, Oversimplified. The basis of inherited property for income tax purposes is the fair market value of the property at the time of the decedent's death. This is commonly referred to as the stepped-up basis rule. In other words, if the tax basis of the deceased was $80,000, on his death it increases, i.e. is stepped up to the value on the date of his death. By way of illustration, if you purchased your property 20 years ago for $50,000 and over the years have made $30,000 of major improvements, your basis for tax purposes is $80,000. If you sell the property for $200,000 without taking into consideration costs or expenses of sale, your profit is $120,000. If you are eligible to claim the above referenced exclusion of gain because you owned and used the house as your principal residence for 2 out of the 5 years before the sale, so that's the actual rule. If you are the owner of the property, you will not have to pay a tax on the profit you have made because it's $120,000 of profit, but it's a $250,000 exemption, so you're fine. You're within the exemption limit. If, however, you do not or cannot take advantage of the exclusion of gain, you will have to pay capital gains tax on $120,000, which you have made in profit at current rates, depending on your income. It could be as high as 20% or $24,000 in federal tax, plus any applicable state and local tax. Yeah, so lots of taxes. All right, so practically what this means, and I've heard multiple Dave Ramsey phone calls about this, is that if you wait until the person dies and you inherit the property, you will get a stepped-up basis, and you can avoid a very significant tax hit, in this case, $24,000. Now, the average property value in the United States is like $250,000 or something like that, so it could be a lot of money, especially if they've lived there for a long time. But I've heard multiple phone calls where someone's parent, because they're very worried, wants to give the property to their kids before they die. And that's a terrible idea. And the reason why it's a terrible idea is because if you give the property to your kids before you die, they will not get the stepped up basis. And so when they sell, they will have to, take this huge full amount of gain into account, and they will need to pay a ton of tax on it. It's not a good situation. So, what's the rule? The rule is do a will. If you want to give your kids some real estate property, do it through a will. When you die, have the will bequeath it to your heirs, and then things will turn out fine. If you are an heir, something else I wanted to mention is that it is very likely if you inherit real estate that you should sell it. And the reason why I say that is because when you inherit a property, it's not likely that you would have purchased that property as a rental property. Just statistically speaking, it's not likely that the house that your parents live in is a fabulous rental property. The other thing is that if you have a property that you inherit, a lot of times it's been bequeathed to multiple heirs, so to someone and their siblings. And if one sibling is keeping the property and then paying the other siblings, that gets messy. And so it's a lot easier to just sell the property. There's not a discussion about what the property is worth. If you sell the property, the market will determine what it's worth. And so it makes it cleaner. And, even if the property is a vacation rental, it's not likely that you would have bought this property as a vacation property otherwise. And so even though, you have memories and stuff wrapped up in these things, just on average, it's, selling is hard emotionally, and it's hard just because you have to go through the process. But it is the cleanest, best thing most of the time. And so that's at a high level. Thoughts that people should know about inheriting real estate, if you ever inherit real estate. Of course, there are exceptions. There will be times when you inherit someone's lake house or whatever, and you're like, I like this lake house. I want to keep it. It sounds good. So, okay, it's very lucky that you had that happen to you. Good for you. You'll know what you want. But I wanted to just state those things up front because a lot of people hold on to properties that don't fit with their life simply because it was easier to hold on to it than it was to sell it. And then later, since they have to pay taxes on it over time, et cetera, they end up in trouble, and then they sell it quickly and they sell it for less money than they could. And they really didn't need to go through all that if they had prepared for it. So final lesson, do not let someone sign their home, their real estate over to you if they want to, if they're doing it because they're worried about dying, because you will end up in a bad tax situation. Instead, have them make a proper will so that you get the benefit of the stepped up basis after their hopefully, their death way later in life. their calm, peaceful death at age 1004, that kind of thing. All right, that's it for video number 161. It's a small detail, but the combination of the fact that most people have their net worth in real estate and the fact that this tax hit can be substantial, I feel like this stepped up basis thing is just a little brain worm that everyone needs to have sitting around to bite you if that situation comes up, so that you don't have something unfortunate happen to the tune of thousands of dollars. All right, that's it. Hope you have a fabulous evening.